And welcome everybody. Thank you for listening in to the 2020 fund review with SKAGEN Global, and we're also gonna say a few words about the outlook for 2021. So with that, we'll dive right into the first section of the presentation, which is to look at what happened to the fund in 2020 and the market. So as a summary, SKAGEN Global delivered about 10% absolute return for 2020. That was the equivalent of lagging behind the index by about 3 percentage points. When we look at the contributors in the portfolio, we had the best absolute contributors being Microsoft, Adobe, and the Danish logistics firm DSV. On the negative side, the worst ones were Beasley, Hiscox, and JP Morgan. I'm going to make some more comments about these later on in the presentation. And quickly kind of looking out toward 2021, we find that the portfolio is well positioned. We think it's attractively valued, and we look forward with sort of cautious optimism. So with that, let's begin by kind of taking a look at the some of the key indices and how different things performed during 2020. This graph kind of shows you a number of the different markets, with the Oslo Stock Exchange returning about 2%. This is all in Norwegian krona for the calendar year. And then on the right hand side, we have gold being the best asset, up 21%. SKAGEN Global here, 10%, index 13%. S&P 500 16, emerging markets also 16, and then in Stockholm we have 19% return in the Norwegian krona. So that kind of gives you an overview of fairly large span from worst to best during this time period. Now looking at again a little bit more at the drivers behind the SKAGEN Global's performance. These are kind of on the absolute ones. But they correspond to some extent to the relative ones as well. Technology firms, I mean, they did well last year. I think that's probably no surprise to anyone. The Danish logistics firm DSV has been in the portfolio for a while. It had another strong year in 2020 after delivering top performance also in 2019. This was driven by sort of good fundamentals from the freight market and the successful integration of the Swiss competitor Panalpina that DSV acquired earlier. All of these three companies remain in the portfolio, and they are fairly sizable positions. We continue to have a lot of faith in them. The analysis that we do show that they continue to be significantly undervalued over our 3 to 5 year time horizon. Now turning the attention then to the detractors. We had Beasley and Hiscox. These are both sort of small specialty insurance firms. They were the worst ones, and that was to a large extent driven by what happened with the corona virus pandemic. The companies, I mean, they came into the year slightly wounded after a number of years of high NatCat, natural catastrophe losses, but they had been kind of turning those things around, taking advantage of some price hikes that were happening for that. But unfortunately, what happened then with the pandemic was that these lockdowns had a sizable negative impact as they led to event cancellations, business interruption claims, and so forth. So it was not the pandemic per se that impacted the names negatively. It was more the fact that you had this type of what has been named many times as unprecedented lockdowns across the Western world. That was something that was, you know, to a large extent the black swan event, but it hurt these companies because they do specialty insurance for these type of circumstances when they don't do kind of the regular auto insurance, but they do more specialty events, specialty sort of commercial arrangements, and that tended to be a bad place to be during 2020. Now, it also meant that the way things have developed, that unfortunately we believe that the fundamentals of these businesses have deteriorated. The uncertainty of the pandemic is still with us. We don't know for how long. I think the implications, they continue to be somewhat difficult to quantify or prognosticate. Plus, we've had some other change in the world's kind of fundamentals that make these investments less attractive, and we have exited both of these positions during the year. JP Morgan also did poorly, as you know, the banking sector as a whole was one of the worst performing sectors during last year. Now, and one comment that we wanted to make about the insurance sector, maybe as the financial sector as a whole, is that we believe that, again, what has happened in the market, in the world rather, is that there has been a sort of huge increase in the debt levels in the Western world. One way to represent this is the balance sheet of the US Central Bank, the Federal Reserve, which, as this graph shows, increased the balance sheet from about 4 trillion to a staggering $7 trillion. Yeah. And we still have talks about further sizable, very sizable fiscal stimulus happening in the US and elsewhere in the Western world. So overall, looking at the way we look at it, you have had a sort of huge increase in the debt levels, and we believe that that's going to be a fundamental negative for banks, for insurance companies, for several years kind of going forward. It doesn't mean that it's going to be sort of poor performance from all of these names during all time periods. You know, this can kind of ebb and flow a little bit, and there will always be a few exceptions. But as a whole, compared to pre-COVID, we think that these ones have taken a step downward in terms of the fundamental attractiveness of these type of businesses. And based on that view, combined with the bottom-up research of the names that we have owned, we have, during the course of 2020, exited the insurance and the bank holdings that we had. And to summarize, you can say that the insurance holdings taken together, they made up the underperformance of the fund compared to the index during 2020. So then when you summarize everything, you put it sort of on the longer term performance. Here's a graph or a graphic table showing you as of the end of December how the fund has performed on different time horizons. This is this year, 3 years, 5 years, 10 years. So about 3 years underperformance in 2020. The fund, end of December was slightly ahead of the benchmark on a 3-year view, behind on a 5-year view. And obviously we hope to continue to grind out higher numbers as we look forward. And the way to get there, and one thing that I think is kind of worth highlighting is this graph that we have shown at several occasions in the past few years, but it's worth to maybe show it again, because this one is an illustrative only kind of way to display how we forecast that the fund will perform, sort of graphically speaking, over time. Yeah. So what we mean is that we believe the fund is going to be an outperformer over time in relative terms, but it's not going to happen in a straight line. I mean, we'd all kind of like that to be the case, but the reality is things tend to go a little bit up and down. And we have been kind of in a period over the past 6 months or so, which is probably more like this, but when we've had a step back in the relative performance. Back in May, the fund was sort of 4 or 5% ahead of the index, and then it's been kind of sliding backwards since then. Now, looking at the fund, the portfolio, again, we think this is more of a temporary blip than anything else, and we continue to follow the analysis, the investment philosophy that we have, and we think that will render good absolute and relative returns over our multi-year time horizon. Taking a step back, just for a second here, and again, this was a slide that I showed you, about the absolute performance of the markets in 2020. And if we look at also what happened in 2019, which are these shaded bars that we've added on here, you can see that SKAGEN Global has delivered on average 20% per year absolute return over this time period, which is hopefully something that is an attractive level for most portfolios. And the way that we think about kind of in the longer term case, and I guess kind of wanted to take the opportunity to again reiterate and give you a case example of what we think will generate and does generate the best sort of risk-adjusted returns over time, is to think about companies that can be in the portfolio for a long time and continuously grind higher, although they may not always grind higher in every single instance. To get there, we think that they need to have, like we have highlighted before, attractive fundamentals, a competitive edge, good financials, solid, skilled and trustworthy management teams, and obviously they need to be undervalued. And the way we think about how to get there is that we have a 3 to 5 year investment horizon, and many times we think even further out in time. We often forecast the financial models for our companies 10 years out in time. And the reason we kind of look further out is because there are fewer actors, fewer competitors, fewer people on the market who take that longer term horizon. The market tends to be a bit more short-term oriented. So kind of this graph showing you kind of the time level as time goes out. The market is kind of looking more short-term, maybe a few months to a year or so out. We tend to have our focus on what's happening again 3 to 5 years out, or even further out, when there is less competition. In practice, then, it means that we try to gauge. I mean, if we have a company kind of being at this point, we try to understand where is the destination of the company, where is it heading to over the next few years, not the next few weeks, not the next few months, but the next few years. And if we can get kind of the destination spot right, then we think that's a good way to deliver performance over time. How the company gets there, kind of the pathway, is less important. Yeah, not every company is going to be the straight line. There will be all kinds of different ways in this type of spaghetti chart how to get there. But again, focus on getting the destination right, and if you get that decision right, then most other things will follow in due course. And one example that we want to show you is this company, and I'm not gonna reveal the name of it quite yet. You can maybe guess, or you can think about which company it might be. But this is a kind of a graph showing you the share price. It is converted to NOK, Norwegian krona, and back in 1999, it was at actually below 5 kroner, Norwegian krona. And you fast forward until end of 2020, the share was trading at 578 kroner. Okay, so it kind of shows you a very nice sort of long-term rise in the share price. If you break it down and you look at the absolute performance for this stock, this is by calendar year, how it has performed. And then the line below here shows you the relative performance, so the performance versus the MSCI All Country World Index. And of course, one observation is that sure, it has been more green than red time periods, but the stock hasn't always gone up in absolute terms. Similarly, on a relative basis, it's not always going up, and actually, and sometimes it has been going down and underperformed the index meaningfully in a few cases. And also in recent years, there has been some extended periods of some underperformance versus the index. If you take the longer view and you kind of look at this is kind of the 1 year, so 1 year meaning the 2020 performance, 3-year being the cumulative return between 2018 and 2020 and so forth. And you look back over the kind of the 22-year holding period, the total return, including dividends, exceeds 19,000%. Okay, so obviously a very attractive long-term return, even though, of course, again, it hasn't always been going up in every single time period. So to reveal the name of the company, what it is, Samsung Electronics, the pref share, which is the one that has kind of delivered this fantastic return over the long-term time horizon. And we bring this up to essentially illustrate that we'd like to have a portfolio which contains a number of companies which can in a way replicate or show you kind of a similar development over the long-term horizon. Yeah, may not be exactly mean this figure here, but again, this is kind of what we try to aim to do to get a portfolio together with these type of companies. And then of course there might be times when there are some big dislocations in the market, like the financial crisis, like in March last year when you had a collapse, even though it was very short, when we can have a chance to opportunistically pick up some other companies. And we picked up, for example, Equinor, the Norwegian oil company, last March when nobody wanted to have oil. The oil price collapsed. Then when it recovered, we actually exited that position here. So that could be kind of a short-term opportunities coming up, but in general, over time, we'd like to kind of get these type of names in the portfolio that can let time kind of be your friend, work to your advantage, rather than having a lot of trading in and out of different names. So names that we think can kind of meet this type of picture or criteria are included in the top 10 list. This is kind of the way it looked back in December, end of December last year. And to again tie some of these numbers to our qualitative investment framework, you can see that we talk about the importance of having a competitive edge. Again, comparing the operating margin or the ROE of the companies of the portfolio to that of the index in green. You can see there's a huge difference between how these companies are positioned, how well we think that they are able to compete. Balance sheet strength, very important, especially to kind of protect the downside when that happens. And again, very strong numbers as a whole for the portfolio. And in terms of undervaluation, these are the price targets on a 2 to 3 year view, and we've seen roughly 30% upside in the portfolio over that time horizon, which to us looks like a fairly attractive risk-adjusted return potential over that time horizon. Now, putting everything kind of into then the sector form, the way MSCI defines the sectors. Here you can see the portfolio, SKAGEN Global in blue, and the MSCI World All Countries in green. And as you know, we're an active fund, so we will deviate from the index, and sometimes very meaningfully so. So currently, no energy exposure, no materials, no utilities, no real estate. That may change, but that was the way kind of at the end of December. And then we have an overweight, as you can see, in financials and in information technology, to give you a couple of examples. Now, we talked about financials earlier today, that we don't have any banks and insurance. So what we have in the financial space are companies that we think are in a way misclassified. Yeah, I mean, we think that these companies, they probably belong in other parts of the universe, but the way that they have been classified by MSCI are in financials. That's why they kind of end up there on the graph. In terms of IT or technology, I mean, that's an extremely broad definition. And to us, it doesn't always make sense to group these companies together because they have very different underlying drivers. Some of the names that we own, like Visa, it's obviously about payments, going from analog to digital payments. We have Adobe, which is more about professionals creating different type of images and so forth. They're from software. We have ASML, semiconductors. We have Google, kind of as an advertising search company. So very different drivers, but they all kind of lump together in one sector. So we're not overly concerned with the fact that we have a meaningful overweight, because again, there are very different bottom-up drivers for the companies that we own. That's all we wanted to say about the 2020. There's obviously more details we can give. If you have any other specific questions on this, feel free to ask them during the Q&A or contact us later, and we'll be happy to provide more input on that year. Then a few words about 2021 and the outlook. I mean, this is always something that is causing a lot of interest to what about the outlook? I mean, what do people think about the outlook going forward when they look in their own or different crystal balls? So for us, a few sort of brief comments about this. I mean, one being that it's human nature to often think about that if one year was good, I mean, in absolute terms, that the next year should maybe be not so good, and vice versa. But interestingly, if you look at, for example, the S&P 500 index in the US, there is no correlation really about the stock market return from one year to another. Put differently, if last year was a very good year for the market in the US, it could as well be, that doesn't have any impact or any real meaning, any significance for how the next year is going to develop. So from that perspective, it makes sort of forecasting in a way a little bit less meaningful than what you might otherwise think. So this graph shows it for S&P 500, but we think it's the same for many other markets around the world. Thinking about the consensus views, I mean, what is being kind of discussed, debated in the market currently? Well, it seems to us that there's a strong consensus view about a few things. For example, interest rates will go up, emerging markets will do well, cyclical stocks will do well when the economy opens up. Just going to mention some of the kind of biggest three things that we hear most about in the market. We've shown a graph here about the 10-year yield in the US. This is, of course, an important graph because if the interest rates were to go up a lot and fast, then that would likely have negative implications for the stock market. And what's interesting here is that you can see, again, a very strong consensus view about interest rates going up, and the predictions are kind of showing you that it will end up somewhere in this range between 0.9 and 1.5 or so. Maybe worth mentioning that today we have the 10-year yield in the US, I mean the generic government bond yield being about 1.04%. And in the table next to you can kind of see the explicit forecast by each of the banks. Our point of view, we don't think that we have any unique ability to forecast what's going to happen with interest rates. So no, we're taking an agnostic view. But we do think it's worth to kind of sometimes take a step back and think about if everybody were like, if the consensus is very strong about rates going up, what if the opposite happens? What if rates actually go down? I mean, sometimes the unexpected tend to happen. So I mean, that's something to probably keep in mind, you know, as you look forward to 2021. One thing that we think is important and worth looking at whenever you try to forecast and look out into the future is what about the valuation level? I mean, the three kind of big things to think about when you kind of look at the markets is what about liquidity, what about growth, what about valuation? You know, liquidity looks pretty good when it comes to, you know, central banks, governments sort of continuing to keep up the stimulus. Growth, obviously much more reliant on what's going to happen to the policies regarding the corona pandemic. And then 3, valuation, which is this graph shows you the free cash flow yield of the MSCI All Country World Index going back all the way to 1995. There are always different ways to think about valuation. There are different metrics. They all have pluses and minuses, but at SKAGEN Global we favor the free cash flow metric because we think it is the cleanest metric. It is much less affected by accounting issues than some of the other market valuation metrics that are sometimes used. So then if we look at the free cash flow yield, the blue line, which as a reminder has the attribute that when it's high, then the market is actually cheap. When it's low, the market is expensive. So when we look at this over time, at least the past 25 years, average is about 5%, so 5% free cash flow yield. Where is the market today? Right here, 5.4%, meaning it's actually a little bit cheaper than the long-term average. So to us, again, we're not in trying to look at the decimal points, but it tells us that the market looks kind of reasonable on a valuation basis, which we like because then it means that there is still a meaningful opportunity for the market to re-rate, to go up from here onwards. So we're not seeing any huge bubble symptoms in the whole market. Of course, there are certain pockets of the market that looks stretched, but as a whole, when we look at the global market, we think that the valuation can support some pretty attractive returns also in the future. And for those of you who were expecting us to tell you exactly what's going to happen with commodities, which sectors to bet on, whether to pile into emerging markets or developed markets, go to small cap or large cap, what's going to happen to the rates, or if there are any currencies to bet on, we have to disappoint you because again, these are high level variables. We don't think that again that we can provide any special input on these, and actually even if we could, it's not clear that that would be so meaningful anyway from a investment point of view. If you think about 2020, if you had known in advance that there was going to be a pandemic hitting, that you were going to have unprecedented shutdowns across most countries in the Western world, it would be hard to have guessed that that would have been a year when the stock market would return a good figure higher than the long-term average. So again, be careful about these forecasts, and we think that the right way is to more look at the stocks. That's what we do when we look at the forecast much more. The stock market is a market of stocks, and that's why we do the bottom-up analysis to find things that we think will be attractive investment opportunities for the next few years. And this graph shows you, or this table shows you some of the investments that we made in 2020. You can see in blue here the different categories that we have, just as a way to group things that we own in the fund, and we were able to find things in these different categories that we think were attractively priced, good fundamentals, and fit the investment framework. And on top of those, of course, we have other holdings that are in the fund that have been there sometimes for several years. So again, this is not all the investments that we have, but it shows you at least a good snapshot of a number of them, and how we think they fit into different fundamentals and different things in the world that will help them over time. And we are confident that they will provide these attractive long-term returns that we seek to deliver over the multi-year time horizon. So with that, I think I will turn it back to Ole Christian for the Q&A session, see if there's anything we can answer in terms of questions.
Thank you very much, Knut. And we actually have a question. I'll read it to you. Taking into account the expected full share price potential for each individual stock, what's the anticipated yield for this year?
Yeah, so now it's not entirely clear from the question whether we're speaking about a sort of a dividend yield, an earnings yield, a free cash flow yield. But the way that I would kind of think about it and maybe and would be to kind of look at a free cash flow yield. If we take that one and we look at kind of the where we are currently, where we think that the growth will be for free cash flow yield of the companies in the portfolio, we end up with a number that is somewhere in the low to mid-teens. Okay, and that corresponds to also kind of where we would expect over time, maybe not a single year, but over time, what type of return potential the fund has. So we're kind of aiming for that low to mid-teens to be a good rule of thumb for the kind of longer term return potential.
Great, thank you. And we also have another question about what, at least we in SKAGEN, are really hoping for, the return of value. What's your take on value versus growth?
Yeah, it's a good question, and it's one that we could have a separate session on that debate here. But the way we think about value, and we have written a white paper on this and published and talked about it in previous presentations, is that we think that in a world that is becoming more and more digital, where technology is beginning to creep into virtually every aspect of life, there has been a bit of a change that's been going on gradually over the past 20 years, maybe even a little bit more than that, where you've had a bigger and bigger disconnect between the way the accounting principles work and the way that the reality looks. This effectively means, in our view, that some of the traditional valuation metrics, for example, the price book, the price earnings ratio, they're no longer as clear indicators of value as they once used to be. Okay, which means that the style kind of guidelines that have been in place before about kind of value being low multiples, growth being high multiples, that is not necessarily the best way to look at things kind of as the world is developing and evolving. So we think that kind of if you take maybe a bit more pragmatic approach to how you define value, we still believe that there is a lot of value to be found in the world of value with the right definition of it. In essence, it's about buying something and paying less for what you get. And you can find that in obviously in all sectors, depending on the companies. And from that perspective, we are again optimistic on the outlook for the fund, and we think that there's certainly a good outlook for value. Just kind of remember to again think about what the definition of value is.